Hello, everyone. This is Joseph Meeks. I'm going to go ahead and finish going over Chapter 3 PowerPoint for Personal Finance. I do apologize that we're not doing this in class on Monday. It totally slipped my mind that Monday is President's Day, so we will not be meeting. There's not a whole lot left to go over on the PowerPoint. I think I finished off around slide 25 last Monday. The remaining slides after that are really just kind of goes over the different ways you can file your taxes. Like for instance, you can go to irs.gov, you can do it yourself. You can go through H&R Block. TurboTax is a really good online software, kind of a do-it-yourself program. Gives you some advice on things to consider when you're selecting your tax software. Some good services available and how to contact them here on this slide. I'm not going to go through all these, but I did want to get to here. So let's say you file your taxes, and for some reason you get a notice in the mail saying that your return is being audited. That means that the IRS wants to conduct a full detailed examination of your tax return. Something caught their eye, something didn't seem to be right, or honestly, there is just kind of a random picking of people throughout the United States who just get audited just as a checks and balances system, where they'll just kind of randomly pick people, whether it's suspicious or not. So I think the takeaway here is that you keep accurate records. This is why you keep your receipts. It's why you keep your records. It's why you make sure something is eligible for a tax deduction before you record it down when you're itemizing your deductions. Because if you do get audited, the IRS is going to need to see proof of everything you put down on your tax return. So just good to know what a tax audit is. These can take a really long time, or these can be incredibly short. Just depends on what your situation is, how big your estate is, what kind of income you had. So that's a tax audit. Like it says here, less than 1% of all tax filers are audited each year. If you claim large or unusual deductions, you're more likely to be audited. And then there's 3 different types of audits. You can get a correspondence audit where it's just something through the mail. It's probably a small issue. An office audit, you may have to visit an IRS just to clarify something that they're not fully understanding. Or you could get the field audit where the IRS will actually visit your home, place of business, maybe even meet with your accountant and really start digging in. So again, it's just really important that tax purposes, you keep everything very organized, keep all your receipts, all your documentation. You can go through that on your own. This is the other part I wanted to go over. The difference between tax avoidance and tax evasion. Tax avoidance is the use of legitimate methods to reduce your tax obligation. Things such as tax deductions. People who buy large swatches of real estate, they get tax deductions for owning that real estate for different reasons, where they have a business on it. Any travel to that land they can write off as a deduction if they're using the land for business. Just many ways of using tax avoidance, using the loopholes in our tax system. This is where your accountant really kind of makes their money. They find these ways for you to legally avoid paying taxes. And then in contrast to that is tax evasion, where you're using illegal actions to reduce your taxes, such as reporting uneligible deductions on your tax return, claiming things that didn't exist, or over-exaggerating the amount of travel you did for your job, or the amount you spent on certain items. So that's tax evasion versus tax avoidance. And then it just kind of gives you a rundown here that on either an education deduction or a tax credit. So tuition and fees allows you to reduce your adjusted gross income by as much as $4,000 for expense paid in the current year. This actually is outdated. I believe in 2023 there are no longer tax deductions for tuition and fees. It is just simply a tax credit now. So this isn't something you really have to worry about, though you can deduct things such as travel expense to and from college. That could be a deduction, but the actual tuition and fees you pay is not. So this is a little bit outdated. But then there's the American Opportunity Tax Credit for going to college. It's limited to the first 4 years of post-secondary education, and you must be half-time. And then a lifetime learning credit is up to $2,000, and it can be used for part-time and education and graduate school funds. So you don't have to be even half-time. Just even like one credit, you can be eligible for the lifetime learning credit, which will reduce your taxes owed. Didn't really see anything else I wanted to go into. We can talk about this for a second, but I don't want to dive too deep into it because we're going to get to some of this stuff when we hit the retirement. But if you're looking for tax avoidance, if you're trying to practice tax avoidance, your investment decisions is going to play a big part of that. For example, if you invest in like local municipal bonds that's issued by state and local governments, the income you get from those investments is tax exempt. So that's a way of earning an income without paying taxes on it. They don't pay a very high percentage, but if you buy a lot of these bonds, it could be a significant amount. Another big one are these tax deferred investments. This is where you put money into, it's almost always a retirement account, whereas you're putting the money in there and it's growing and with the investments that it's in, but you didn't pay taxes on it when you put it in. You don't have to pay taxes on it until you start pulling it out. And because it is still considered part of your income, although you put it into a tax-deferred investment, you do get a write-off any amount. You do get a tax deduction for any amount you put into a tax-deferred investment. These are, I would say, the single largest deduction for most people outside of maybe their home mortgage insurance and interest. So. Capital gains, you gotta be careful with that. There's not usually a lot of tax savings on capital gains. The long-term capital gains is about 20%, but you have to keep that investment for over a year to only pay 20%. If you sell it off within the first year, you're going to pay your ordinary income tax. So, I'm going to keep that in mind. And then the chapter kind of goes into some very specific different retirement plans. I'm not going to jump into those. I don't believe there's any questions on the homework on it. I just looked over the homework. I didn't see any. We'll get to these once we get into retirement, but just know that all of these, traditional IRA, Roth, well, not the Roth IRA, sorry, traditional IRA, SEP IRA plan, 401k, covered IL, and 529 generally work as a tax deferred or tax sheltered investment plan where you can pack money into it over years and years and years, get a tax deduction for your contributions to it, and then you don't pay taxes on it until after you begin withdrawing it. The Roth is not that way. The Roth is something completely different. We will talk about that during retirement. This 529 plan, these are state plans, so you don't get a federal tax deduction if you put money into a 529 plan, but states that have a 529 plan generally do give you whatever you put in as a state tax deduction. For instance, Colorado has one. That's where my kids' plan is through, and I believe you can deduct up to $3,000 a year from your taxes, from your taxable income through the state tax on a 529. Yeah, and I think that's really it. There's nothing else I feel I need to go into. Hopefully you're all reading the chapter. You're learning all this anyway. You're spending the time. Maybe going through the PowerPoint while reading the chapter. If there's any questions on any of this, or you just want to talk taxes, that's great. I do have office hours Monday and Wednesday, 9:50 to 10:50, and then 1 to 2, and Tuesdays 10 to 11. Obviously, next Monday I won't be here for that, but anyway, so that's kind of wraps up the PowerPoint. The next thing I want to go into is the homework assignment. Like I say, I did just look over the homework, and there were a couple of questions that I feel that you might be having some issues with. So the first one I'm going to look at and kind of go over is homework question number 7. It's about finding the taxes owed in the following situation. This is what I said I was going to do this Monday. I was going to do this math equation for everybody during our in-class lecture. Unfortunately, that's not going to happen now, so I did feel I should at least come on here and do one so you understand how to do it. So 7A says, determine the amount of federal taxes for the following situation: a head of household with taxable income of $65,000. And then I know it gives you the little link for the tax brackets. So the first thing you want to do is go to the table of tax brackets, find here heads of household, and then look at the rate on taxable income versus the amounts over here. So what this is basically saying is the first $15,700 is going to be taxed at 10%. So that one's easy. So you take the 15,700, the first 15,700 of the taxable income, you multiply it by 10% or 0.1, and you get 1,570. So that's how much tax they owe on the first 15,700. The amounts between 15,701 and 59,850, if you go back here, 15,701 to 59,850, that amount, the difference between those two, is taxed at 12%. So you do the math, you subtract the 15,701 from the 59,850, and you get $44,149. That is the amount that's going to be taxed at 12%. So we multiply the 44,149 by 0.12 or 12%, and you get $5,297.88. So this 52,987 is the amount of taxes they owe on the amount between 15,701 and 59,850. Okay. And then you just take the remaining. So they have a taxable income of 65,000. You see that the 12% only went up to 59,850. So you take the 65,000 total that they made, you subtract out the 59,851, because that's the number that starts the next marginal tax bracket here, right? 59,851. You subtract that out and you get an amount that is $5,149. So that's the remaining amount that you haven't figured out what they owe taxes on. That amount is taxed at 22%. You see it over here, all the way across. 59,851 all the way to 95,350 is taxed at 22. But our family only had 65,000, so we cut it off at 65 there, and we found the difference between the two. So you take the $5,149, you multiply it by the 22% or 0.22, because that's the tax bracket that amount falls in. You get $1,132.78. So what you've essentially done here is found the amount of taxes owed on the amount of money they made in each marginal tax bracket. The first the 10%, then the 12%, now the 22%. So now we just add all those up. 1570, 5297.88 plus 1132 and 78 cents. Add all those together. You get $8,000.66. So that is the exact amount of money that this family owes in taxes based on the marginal tax system that we have here in the United States. But you got to be careful because the question asks to round to the nearest whole dollar. So what you will actually put into the homework on Connect is 8,001, and that is the right answer. So that's A. There's a B and a C. You do it the exact same way. Okay, it's the exact same. Steps to get to your final total taxes owed. So that means this family paid 8,001 in taxes based on 65,000 taxable income, doing a heads of household filing. All right, another one from the homework was question 10. You're going to need to be able to access that table 1B from appendix 1. What you're probably going to have to do is revisit the homework assignment from chapter 1 where it gives you the link to appendix 1, table 1B, because on this homework it does not, and a lot of future homeworks don't give you the link. So my advice to you is that you take a screenshot of all those tables, 1A, 1B, 1C, and 1D, and you keep those readily available because throughout the rest of the semester, there's going to be questions that you'll need to refer back to one of the tables, and they don't give you the link. And for some reason, it's not in the textbook this semester. So you're going to have to refer back to that, to 1B, to be able to solve question 10. All right, question 11 is another tricky one. We didn't go over it at all. It's not even in the PowerPoint. It just talks about it briefly in the book. So the question asks, or says that Julia has $42,000 of AGI and $5,000 of medical expenses. She expects to itemize her tax deductions for the year. The most recent tax year has a medical expense floor of 7.5%. How much of a tax deduction for medical expenses will Julia be able to take? So what that means, having a medical expense floor of 7.5% means that 7.5% of her total adjustable gross income is not deductible as a medical expense. So first you find out how much is not deductible. So you multiply her AGI of 42,000, multiply it by the 7.5% or 0.075, and you get 3,150. So what that means that the first $3,150 towards any medical expenses that Julia has is not deductible on her taxes, but the remaining is. So in her case, she had $5,000 on medical expenses. The first $3,150 is not deductible, but the remaining is. So you just subtract the $3,150 from the $5,000, and you get the deductible amount of $1,850, and that is the answer. Question 12. I can let you read through that. It just has to do with the lifetime learning credit. You only get 20% of the education expense as a tax credit if it's under $10,000, and her expenses are only $1,800. So you just basically multiply $1,800 by 20% to get that amount. I'm going to leave 13 up to you guys to work on. I don't feel it's that difficult, but it is a little tricky. You kind of have to try to understand exactly what it's asking before you can figure it out, but then it's really easy. If by Tuesday you're still having an issue with it, let me know. I can work on it with you. Question 14, again, you're going to need that table 1B from appendix 1. So you're definitely going to want to find that in one of the previous homeworks and take a screenshot of that. And then questions 15 and 16 also I feel like you can all figure those out on your own. They're not overly difficult, but it will take a little bit of thought and a little bit of research through the book uh, to figure out how to do those. But again, if you're unable to by Tuesday, just let me know and I can help you out with them. Remember, this Chapter 3 homework is not due until February 23rd, so that's a week from this Sunday. And we do have exam 1 next week. I'll put out a little more information on that probably Tuesday morning when I send out my announcements. So. Okay, I think that's all I got for this video. I hope everybody's doing okay. Hope the homeworks are going okay for everybody based on the grades they seem to. I haven't seen really any major issues with either Chapter 1 or Chapter 2. So, all right. Have a good evening, everybody. Have a good weekend. We'll talk with you next week.